few of them in this video. Okay. Market has been playing up a lot recently. A lot. There's no doubt about that, okay? But what does that bring? Opportunity. It brings a lot of amazing opportunity out there. There's so much, okay? In the video, I've just compiled only a few, I think are the key ones, okay? For any really beginner investor, okay? These are simple companies, they're high quality companies, and by simple I mean their model is easy to understand, okay? And I think they're good. I think they're good quality companies, okay? And a lot of them here, a lot of them on this list are dividend paying, because this market right now will benefit the dividend investor, okay? Things are going down. Number one, the yield is therefore going up. Number two, okay? Very simple formula. Very simple thing to look at, okay? Now, the first company I'll be looking at is T Rowe. And if you've been on the market at all recently, okay, for almost the longest time, you would be thinking, why T Rowe? What does T Rowe bring to the table? And I'm going to tell you, okay? Since T Rowe is at such a low cost right now, okay, they are near the 52 week low, a dollar 60 above. Whoa, you know what I mean? This does weirdly puts it in a weird spot where, although the price performance has been pretty poor, it's good value. But look, 5.4% dividend yield, paying almost 5%, paying almost $5 per share. You almost never see that. You almost never see that. Hardly any company even thinks about paying that much, okay? That means if you were to buy T Rowe right now, at the current share price, you'd be getting an almost 5.4% dividend yield, and that is, since T Rowe is actually a decent quality company, that's actually, it's amazing. It's awesome. It's for lack of better words, it's awesome, okay? And there's not much else to say about it. Now, as as you can see, okay, T Rowe has a beta of 1.4. What does that mean? A beta of 1.4. Again, beta is not the best metric to measure volatility. It's not. Okay, everyone who is somewhat into technical or quant analysis, they know this. But what does it mean? For every 1% the overall market moves, T Rowe on average will move 1.406%. That's just what it means. So it's a relatively slow moving stock, which is good for the longer term investor. Okay, it's good. Now, why again do I say T Rowe? Okay, because look, they haven't been doing well price action wise. Okay, they've been at a low for a while, and by a while I mean they've been trading horizontally for what's it, like just under 3 years. Under 3 years, very horizontal. And as much as I hate to say it, and if anyone ever says this to you, they are taking your money from you, okay? If you look at the past almost 3 years, you see a pattern. It moves like a big channel where you can almost predict what the price is going to do. Almost, I say almost because you can never predict the price. Remember that. You never predict price movement. You cannot. It is literally impossible to do so. Okay, but it's undeniable. It hit this this support level three times in the past, and it's hit it twice in recent days, and it has a little bit of play now. But again, you can never predict where the price goes. Okay, if anyone says that to you, they are taking your money. Okay, they're hooking you to try and sell you something. Okay, but it's a bit undeniable at this point. It is moving way too horizontal to make any trades, which we really shouldn't be doing. But it's easier to kind of get a grip of where the low point would be for T row. Okay. Okay. Now the next stock I've picked out is Target. Why is Target in my eyes such a good quality company? They're sub 140. They're in that sub 140 level. Okay. So, and for those who've been living under a rock for the past, I don't know how many years, okay, Target is one of the largest supermarket chains in the U.S. Okay, they it's a consumer staple company. People will always need a supermarket. Now we look at the financials: 4.31% dividend yield. Are you crazy? Are you crazy? Paying $4.5 per share. Okay, at these prices, you're joking. You're joking. It's amazing. It's an amazing opportunity to at least look into, at least consider it. Okay. Now, if you look a little more at the financials, they have a beta of 1.0371. Okay. What does that mean? Every 1% of the market moves, Target will move 1.0371% on average. Okay. That's never a guarantee. And remember, the beta is not the best volatility index there is out there. It's just a number to make it easier to imagine, okay? Now, look at the charts. It's been a bit rough. It's definitely been a bit rough, okay? Now, why is this? Why has Target been going down so much? We're going to look on TradingView. And this is honestly like one of the only things you're using TradingView for as an investor, okay? Because Target missed their earnings twice last year. They missed it twice last year. And the market, in the market, you see, you either need to meet expectations or you need to surpass them. You can, if you miss them by the smallest amount, as you can see with Target price, it missed it by 45 cents per share. 45 cents per share, and it went down almost 20%. Sorry, no, I am so wrong. What did I just say? It, yeah, Target missed by by 15 by 45 cents. Okay, they missed their EPS by 45 cents, and on and on the chart, we'll measure out the change. I'll measure it out for you. Okay, the market sold off Target by nearly by 22%. 22%? What? And it's been on a downward trend since, but that's a bit of a gold mine. That's a gold mine. Dividend investor, listen up, lower price, you get a higher yield. That's just how it works. You can buy up more. You can buy up more of Target. Okay? Your $200 will get you nearly 2 shares now instead of that maybe 1 point something. Okay? And that does make a difference. It makes a very big difference, okay? But if you look in the past, Target earnings, you can never really go off them. There is, at least for me, when I look at it, there's too many reverse reactions with earnings to make a decision. Now, this is the Target financial site. A little bit scary, but a quick Google search will summarizes everything. Okay, look, you have all these different files. As the average investor, you don't look at any of this stuff. Okay, just Google it. EPS. Okay, sorry. They've lost 3.15% on revenues year over year. It's been a bit rough for them. It has been. Okay, they are down on EPS. They are down on revenues. They are down on a whole bunch of stuff. Okay, and it's been rough, to say the least. Okay, EPS has been on and off. They've missed by 1.24, gained by 17.7, missed by 19.6, beaten by 7.08. It's very, very mixed, okay? But undeniably, that does make undeniably. Besides the EPS, besides all of this, and the misses, and the beating, and all of that, okay? Target pays its dividends. It increases its dividends, and it has been going down, which although sounds very bad, over the shorter term, not too bad. Okay, it means you can buy up more, then you can get more, then you paid more, and more, and more, and more, and more. The next stock I have picked out after Target for a couple opportunities, I think, Microsoft. Do I need to say anything? Microsoft is sub $400. If you're not frothing at the mouth of Microsoft being sub $400, what are you doing? What are you doing? They are a dividend growth machine. Fuck. They're amazing. They're amazing. There's nothing else to say. Dividend of 0.83, not too much, but they grow it. Look at this. They grow it. They grow by 10%, 10.67% from the beginning of 2024, from the beginning of 2024. Okay, growing it by 10.29, growing it by 9.68. They grow their dividend, as you can see. They grow consistently from 2021, 2022. They grow it, and this is only going to go higher and higher because Microsoft has so much cash. And look, and what else is there? Okay, well, just my broker shows news sentiment, and I said that is neutral. Don't look at that. Microsoft stock down 7 days in a row. Okay, it says neutral, whatever. Microsoft down, stock down 7 weeks in a row. 7 weeks in a row. Okay. I don't know why the media says that's negative. For dividend investors, that's beautiful. And I'm sorry that the screen recording is so unbelievably bad. I am so sorry. That's just, it makes it better. You can buy up more Microsoft. Like, they have so many streams of revenue. And, sorry. They have base at 1.23, which means for every 1% the market moves, they move 1.23%. How do they bring value to you, the shareholder? Stock buybacks. What's a stock buyback? It's when a company repurchases in a way its ownership, which means there's less shares in circulation, which ultimately increases the value of your individual share. In the first quarter, they bought 11 million shares. Then second quarter, 7 million. Third quarter, 7 million. Fourth quarter, 7 million. And for this period, I completely forgot. For the 2022, old news I know, but it's relevant. They bought 32 million shares back. Oh, sorry. What am I saying? 2024. 2024, they bought back 32 million shares. And that only brings you value as an existing shareholder. Okay? Dividend per share of 3. And look, oh my god. They brag about this. Every company or investor will brag about this. Microsoft has beaten the S&P 500 over the past 5 years, okay? On average. They had a little slump here in 2021, but on average, they've beaten the S&P 500. This single company is beating the performance of the top 500 biggest companies in the US market. That's insane. It's absurd, okay? By that margin as well. That's pretty good, okay? And, yeah, they're just amazing. Now, as I know financial reports can be a bit scary sometimes, but here I've just Google searched it, a summary of the Microsoft earnings. Revenue, year over year, up 12.3, net income, up 10.23, diluted EPS, up 10.24% year over year, operating income. They've almost doubled their cash. 94.7% increase in cash year over year. They've nearly doubled it. EPS beaten quarter after quarter after quarter after quarter in 2024. They're growing. 3.4, 0.23, 6.1, 3.1%. They're growing. You can't stop them. Windows is not going anywhere. OneDrive is not going anywhere. You use Microsoft whether you like it or not. If you're in any job, okay? They're increasing the dividends. They're a dividend growth machine. Look at this, 9.68 from 2022. From from 68 cents per share to 83 cents per share from late 2022 to the end of 2024. It's amazing. They're growing. Okay, enough of Microsoft Glaze. I have Pepsi as another stock that I think brings great opportunity. Why? Pepsi is like the grandpa of dividend stocks. Okay, they are matured, they pay consistently, and they've been paying, as a matter of fact, for a few decades, which makes them a dividend. I think it's a dividend king. I think it is. Okay, and they have a price target of 170 from 145. Okay, now analyst reviews are a little bit mixed. But overall, they are predicting 170 to be the price the price target. Okay, Michael Lavery has bought more. Pepsi. I don't know who that is, but my broker says he's someone important, so I'm just going to go with it. Okay, he's bought up more. Okay, and if we scroll down here, hedge funds decreased their holdings. Okay, by 2.4 million, no big deal. And some guy called Ken Fisher added that, whatever. But corporate insiders sold. But what does that mean? It's better. Pepsi becomes cheaper for you and I. Okay, we get a better dividend yield. Okay, because Pepsi, very slow, very slow grower, very slow mover. If you look at the financials, okay, they pay 5.42 cents per share, $5.42 per share right now. What I think the last time I looked at them, they're at 2.9 or something. That is insane. That is insane. Pepsi, they keep increasing dividend. Yes, their stock is going down, but they increase dividend, and they're a very slow mover. Remember what I said? If you're someone who likes stability, according to their beta, Pepsi only moves 0.35% for every 1% the overall market moves, because they are matured. They are a very matured brand. They're like pickles. They're marinating. Okay, consolidating. Then they are still growing. Okay, without a doubt. And they have a whole slurry of things going for them. They have a massive profit portfolio, and they've been increasing the dividend. That's a lie, by the way. That end bit over there, that is a lie. I confirm this. They are still increasing dividends. Okay, you have increase of 7%, 10.43%. So 6.5, 5.88, 6.25, 0.52, 2.96. They're increasing the dividend very consistently, very slowly, but consistently. Now look, okay, Yahoo Finance. Look at their I don't know what it was. Their gross profit. Okay, they're growing, and nothing's gonna stop them. Nothing's gonna stop them because they have so many streams of revenue. They are such a well-established brand. They are so well-established. Okay, and see that they're just growing from 80 to 86 to 91.85. They are just growing, and they have, remember I said they have a whole slurry of things going for them. Besides this, okay, besides their quarterly earnings going up and up and up and up and up, they have a massive product portfolio, very well ingrained in your minds. Okay, I'll just search up the little graph your business class shows you. Like, oh my god, look how many brands they own. Look at how many brands they own. How many? Cheetos, Lay's, Fritos, Doritos. They own Yum Brands, who owns KFC, Taco Bell, Pizza Hut. They own Quaker Oats, okay? Everyone's had oats in their life, okay? They own Mug, which is a root beer brand. They own Aquafina, Tropicana, Pepsi, Dole, which as far as I know, they sell bananas. Well, I don't know what else they sell, okay? They own Gatorade. That's in the NBA every single time. They have 7-Up. They have Ocean Spray. Mountain Dew. Doesn't The point is, they have consistent market exposure to the average consumer, and this is a key point. With increasing cost of living, people are going to be looking for cheaper food alternatives, like KFC, Taco Bell, Pizza Hut, Pepsi. They have that bracket of consumer for them. They do. People of middle to lower income will be going for these brands more and more often as things get more expensive. Okay, Pepsi has it found. They found out they have those consumers in their pocket. Okay, if they keep the prices relatively low for their fast food, it'll stay that way, and they'll keep growing. Money wise, they're gonna keep growing, and another okay, another company, two companies actually, they're in relation to each other. Lockheed Martin and Boeing. Why? Because now in the defense sector, as of Trump's recent announcement to be working with Boeing, Boeing has shot up like crazy. Okay, which is very very funny because Boeing's a bit notorious for being a bit of a bad company. Okay, and with Trump's announcement to be working with Boeing to for defense manufacturing, as you can see, although they've been on a bit of a slump earnings wise for a while now, we can potentially see some kind of reversal. They now have a price target of 193.5 from 178. Okay, I'm not going to go too much on Boeing because I just don't know enough about Boeing. Sadly, I wish I did. Um, but yeah, 193 price target. My broker says they're a moderate buy according to analyst consensus, and yeah, which is if you were to buy a couple of shares now, and now look, Boeing is again, they don't pay dividends. They have a negative earning per share ratio, um, and they have a beta of 1.02. Okay, this can very well change when we see the Trump effect, but as of right now, I don't think it's too great. Lockheed Martin, I love this stock. I love it. I'm down, but I don't care. Do you know why? Because they're they're amazing, and I'll tell you why. Okay, they're at low number one. They are a very low considering their 52 week highs. Okay, and they have a backlog of orders. With defense, you need a backlog. I'm going to show you it here. They have a backlog of $176 billion. That is a lifetime worth of consistent income that will be going to Lockheed Martin. And with the way the world is going now, I really doubt that's going to go anywhere. I see it only growing. Despite Trump's decision to partner with Boeing, I see it's only growing. Okay. Now, how else do they bring value to you, the consumer? How else?